Well, hi there, and welcome back to another episode of Let's Talk Real Estate Investing. I'm your host, Sharon Vornholt, and I'm so happy you're tuning in today. Today, we are going to be talking with Adam Zach about how to buy and wholesale MLS properties with the rent-to-own strategy. Adam and his business partner provide a path to home ownership for folks that can't get a traditional bank loan. He likes to say he's a family man with a business, not a businessman with a family. He's been married for 8 years and has 3 young children. Adam is passionate about helping working dads achieve time freedom through real estate, and I want to welcome Adam to the show.
Thank you very much for having me. Excited to be here.
But tell me a little bit about how you got started in this real estate world.
Sure. It was, I like to say it was just trying to pass the marshmallow test. And by that, if you haven't heard of the Stanford study, it's, they put toddlers in a room and they say you can have 1 marshmallow now, or if you wait, basically just the idea of delayed gratification. And so for me, it was, if I get good grades in high school, I can get into college. If I get good college, I can get a good job. If I get a good job, I get good income. If I get good income, I can save for retirement. And then and it's like all that delayed gratification made sense until they told me to wait in the room for 40 years to have the second marshmallow.
Right.
Like I firmly believe that stages 1 through 4, everyone should be really, but then all of a sudden I started to question, okay, how long do I really want to wait for that second marshmallow? And if I can wait 15 minutes like they did in the study for a toddler, which is like 15 years for adults, because a toddler is just, staring at that marshmallow for 5 minutes is just like excruciating. It's a really funny YouTube video. And so my dad instilled a lot of those principles with me, but that was just what can I do now that banks later, but then something just kind of switched. And so then I was like, okay, what does that look like? And for me, it was some form of entrepreneurship. So it was fantasy sports, it was day trading, it was real estate, it was starting my own business. And then eventually it was like, okay, the very first way I got into a property was I just listed my primary residence for rent instead of selling it and moving, which I think is one of the biggest hacks for people to go from 0 properties to 1 is to keep that first property. It's such a huge deal.
Yes, and I know so many people that have done that. And when I think back 25 years ago, no one was doing that. We sold our properties and we moved on to the next property. And I often look back and think to myself, why didn't we think of that back then? But we really didn't. It wasn't the way it was done, but it's such a smart way to get started today. But let me ask you about your niche, your rent-to-own lease option, whatever you call it. How did you land on that as your focus?
It was probably pivot idea number 4. So it was like the first 3 things we went through was like, oh, let's fix and flip properties. Okay, we suck at that. Let's not buy a 1900s house because those are the only ones that seem to cash flow. And Brandon Turner told me I needed 8% cash on cash because I watched a Bigger Pockets podcast one time. And so it was like, just make it cash flow. Then it was our first variation, which was called Set Your Rent, which we told college kids, go pick out any home, give me your max rent amount, and I'll tell you which home I'll buy off the MLS for you. So anyone could use that strategy. If you just say, hey, 4 college kids, what's your monthly rent? And they'll say $2,500. I'll say, cool, go pick out any home, $240,000 or less, and I'll buy it for you. And the day I close, you move in and rent it. So I at least am cash flowing day 1. And so that was version number 1. But then after 2 years or however long their lease was, market rent was maybe $1,900. So it worked for a while, but then I was like, okay, well then I, kind of got back to reality. And although we, did this unique niche, I was like, oh, what if they did that, but then bought it afterwards because real estate's appreciating. And so I had a friend that was like, hey, I can't get a bank loan. You're a civil engineer. If I talk to any lender, they'll give me a pre-approval letter in about 10 seconds because I got an 800 credit score and I got a W-2. But essentially, I'm now in that position where I honestly can't get a bank loan because I show a paper loss because I have so much real estate. And so my debt to income ratio is essentially 0. And so it doesn't matter what I do. So what I would do is that I would go to Sharon. I'd be like, Sharon, will you buy me a house? And you might think, well, what do I know about Adam? What about the asset? And then probably the economics. So then I usually would pitch Sharon and be like, hey, if I bought a home here in North Dakota for $400,000 and I call it 50 grand down, whatever your interest rate was, I'll pay you that, pay the taxes, insurance, and then just give you $500 a month on top of that for you to basically buy me a home. And instead of being a first position loan, because for you, Sharon, that's a little bit riskier because if I default, it's a foreclosure. We've structured it so that it's Sharon would take title, then sell it on a lease with an option to buy. In the event that Adam defaults, I lose my option fee. You then can have an eviction. And then we started figuring out that you could actually apply rent guarantee insurance as an additional layer, just like the banks do private mortgage insurance. So we're really trying to, make some sort of teeter-totter, almost like a private mortgage, just with strategic contracts and ways of doing that. So instead of finding the property first, people second, we're people first, property second.
So talk about that insurance a little bit. Tell the folks that might not know about that, how that works.
Yeah, I had no idea this existed, but I was like, but again, it was just me like, okay, if we're finding these tenant buyers and there's a reason they can't get a bank loan, could be they're self-employed, could be that they got terrible credit, could be a variety of reasons. Now that I'm a mortgage loan originator, I get to see like, okay, these are the reasons, but they're riskier. So I was like, well, what do banks do? They're like, oh, if you do FHA, they just have private mortgage insurance. I was like, oh, well, can I get that? And they're like, no, you can't get that. And I was like, well, what? I can't get mortgage insurance, but what can I get? So there's 3 companies. So number one's called the Guarantor. The next one's called Leap Easy. And the third one's called Single Key, which is in Canada, but I think is coming to the United States. But essentially, per $2,000 per month of rent coverage, you might pay something like $83 a month. And essentially what it is it'll pay up to $1,000 of, call it repair costs, $1,000 of eviction, and up to about 6 months of lost rent if you have to evict the client or if the tenant, or if they move out. So essentially your biggest risk on someone is like, hey, they move out. Well, then you put an insurance on there, make them pay for it, just like borrowers for a loan pay for private mortgage insurance. So essentially you have them, you apply for that, you place it on there. The Guarantors has a minimum credit score of, I think, 620, where Leap has 0 underwriting. You can place coverage on any single family home, any single apartment, anywhere. And all you do is you pick your price and they have a corresponding premium amount to that. And so we now place that on all of our properties moving forward.
So how do you get your properties that you said 80 a month? So you have to have a better than average cash flow to factor that in there.
For the properties, the cash flow?
For the insurance. If you're adding that, you're taking that, you're placing the insurance, I'm assuming increasing the rent by that much. So it has to all work out number wise.
Yep, you got it. So what we do is instead of finding the property, the person finds us and they say, hey, what sort of home could I get approved for? I'm like, okay, well, if you make, call it $9,000 a month, we'll approve you for a $3,000 a month payment, which in our terms, and depending on what Sharon would want, like, what would you want to approve them for if they're putting 10% down? Is that a $300,000 house? Is that a $250,000 house? So in general, we set that up we would say, okay, you're approved for generally a $300,000 house, putting 10% down, paying $3,000 a month. If I'm just using like the 1% rule and putting 10% down. Now it varies depending on the taxes, the insurance, Texas versus Alabama, you're paying, drastically, but essentially we're setting up something so it's nothing less than a 20% cash on cash ROI. And then we have them go pick any home listed for sale with a real estate agent that's $300,000 or less. And they already then know their monthly payment, their terms. It just happens to be that we're buying it, the real estate agent showing it to them. It's like Divvy Homes or Home Partners of America. They're the 2 national companies that do this, but maybe not on an individual level. They do it on the major metros.
Okay. So, let's talk about the interest rate. You mentioned 1%. Is that your interest rate per month? Like, are we looking like a private money loan or something like that?
Yeah, I would say probably the easiest way to equate it is like investors that do a DSCR loan. We would probably be the equivalent, but for owner occupied homes. So we don't charge an interest rate because it's rent with a locked in purchase price. You could probably back calculate into what the interest rate would be, but essentially Adam would be paying Sharon $3,000 a month, getting $300 a month as rent credit that I get to use towards the locked in purchase price of $320,000 anytime in the next 3 years that I want to exercise the option. So I'm building maybe $300 a month. I do that for a year or 2 years. So there's maybe $3 to $5 grand that I've built up plus the 30 grand that I've put down. So when I buy you out, it's 330 minus the 30 grand that I put in minus whatever rent credits I've gotten. and then I would buy it back from you, basically on like exercising my option to buy it. So it's not technically an interest rate, but I would say if we're borrowing from the bank at 7 or 8%, it's something higher than that.
Okay, so that was my question. I'm trying to understand. So you're getting a traditional mortgage on the property. So whatever that is, it's whatever it is. And then you're doing like a traditional lease option way.
Yeah, so that's what we did for, I'm going to call it phase 1 of Home Equity Partner, which was my business partner, John, and I. We just did 40 of these, had enough cash flow to quit the W-2 job. And I was like, cool. Well, what's next? And now we're playing more matchmaker, where we're finding the tenant buyers. I'm helping other dads, W-2 individuals that want cash flow, because this type of a structure is more of a cash flow play than a wealth play. If you want long-term wealth, just buy a single family, traditional, multifamily, whatever it is, find an off market, do the bird, like that over the long term is going to, with appreciation, debt pay down, all this, but we're almost more like a 3-year high cash flow play option for individuals that are really looking for more time freedom. And typically what I've heard is that it's the passive income number or the monthly cash flow that's going to allow people to, maybe free up their time to go to 30 hours a week or 20 hours a week in their day job.
So that's interesting. That's interesting. So you don't have any properties yourself that you're renting in this, like a lease option. Okay, that's interesting.
Correct. Yeah, and I think that's one of the more unique things, because it's if there's an existing inventory, you just list it on Facebook Marketplace, on Zillow, whatever it is, and someone finds it. But in this case, we just have a list of 100 people that want us to buy them a home. They go shopping with a real estate agent, and if you're in a typical town, it's like a 10-to-1 ratio on homes listed for sale versus homes listed for rent. Like in Fargo, North Dakota, there's 1,200 homes for sale, 120 homes for rent. Wow. And so what we're doing is saying, you now have the option of picking from these 1,200 versus these 120.
Mm-hmm. So are they in general willing to pay the asking price then?
So
who determines how much you pay? Do you negotiate the deal or for them?
We ask them what they want to offer on the property. If they want to offer over asking or over maybe what some comps will support, we ask them to basically come in with the extra cash. But in general, they're driving the decision. And then we're adding in the buyback price on top of that. Now, it would be great if we could buy it at a 90% discount. And if you can buy off market, I would say more power to you. We just happen to find a strategy that it still works for us or our investors to buy a retail property at $300,000, because the client is going to pay $3,000 a month. They're locking in a purchase price. We add maybe 4% appreciation per year that they're then buying it back from us. So we kind of have a 0 vacancy plus an exit plan. Okay.
Now, you mentioned real estate agents. I would think that real estate agents would be your biggest advocate here, because I had a home inspection company for 17 years, and I know how important real estate agents are in a lot of instances for these transactions. So tell me about working with them and how do you get them on board?
So I would generally say that, so real estate agents, and I call them tenant buyers. That's kind of the vernacular for the rent to own, is I would say you really have two choices. You could rent, you could wait and get a mortgage. And those are two great options. Really, where we're the financial tool for a real estate agent, if they're like, hey, my deal's about to fall through, or I got this client, they're self-employed, they really want a house now, like I could be a financial tool in their toolbox for those specific clients. But I would imagine most real estate agents would just want people that are already pre-approved, making a lot of good money, and they just fly through. But this is for maybe some real estate agents that are like, oh man, like this is a way to maybe attract new clients or new clientele. And so our company will come in, potentially buy the home all cash, sell it to them on a rent with an option to buy. And then we become the agent's client as opposed to their existing, tenant buyer client, even though they're still showing the homes. We're not even local. We do all of this virtually. And so it's still the home inspection, still an appraisal. But then this way, our company as an LLC can come in and buy the home, so the real estate agent can still get their 3% commission or whatever the structure is.
Okay. So that would be an important thing for them to partner with you, is that they get paid. As long as they get paid, they pretty much don't care. So that was my next question. Are you doing this locally or virtually? And where, if it's virtually, where are you investing?
So right now we're doing it across the United States. That's one thing that we're really unique is we're not metropolitan agnostic. It's any home anywhere because we're people first, property second. What we have found is that the Midwest to Southeast, call it North Dakota down to Texas, and then over to maybe Florida and up, has been most of our target because the price to rent ratios make sense. Like in call it Colorado, a $300,000 home might rent for $2,000 a month versus in Ohio, a $300,000 home, we can get $3,000 a month in rent. And that's the cash flow we want because we're locking in and basically the investors giving up some sort of appreciation or shared appreciation. So the model doesn't work as great in low cash flow or low rent to price ratios on properties that appreciate, typically like the California. So in general, any city, anywhere, it's more about the person than the property.
Okay. What does your typical buyer look like then?
So I would say someone who's probably close to a 580 credit score. So they're either on the verge of, getting FHA or getting close to the 620. They make probably $9,000 to $10,000 a month. Either they have coming off of either a bankruptcy or they haven't figured out their credit, or the big one is like they need to wait until 2024 to file their taxes because they need 2 years of tax returns before the bank will count their income towards their debt to income ratio. And so a lot of them are high income earners that want a home, but they just don't quite fit the bank's box of DTI, credit score, or length of job history.
I was going to say that's a low credit score for somebody making $120,000 a year.
It is.
Wow. So what is the typical timeline then for them to refinance? Do you do on your rent owners, are you doing 2 years, 3 years, or I would assume they have the right to extend that if they don't quite get to where they need to be?
Yep, they have a 3-year. Anytime they buy it before that, there's no prepayment penalty or anything. There's a pre-negotiated price that they can buy it at any time during it, and you know what the price is, and then we give them the option to extend it one time for 12 months, so they can go up to 4 years. And the idea being, if you can't get it figured out in 4 years, there's probably something else going. And if that's the case, maybe we just sell the home, liquidate, and just like if you were in a home and try to get everyone's capital back. Maybe they, if they truly just want to move out, which I wouldn't suggest someone doing because there'd probably be a lot of equity in the home, depending on what the real estate does. But I guess that is to their benefit. If they're just signing an option to buy, that doesn't mean that they have to. So for me, if I was home shopping and I could get an option to buy a $300,000 house for $330,000, and all of a sudden the market goes to $150,000, well, I'm not exercising my option, and it's way better in my interest to either, I suppose, wait and hold and hope real estate goes back in, but that's some risk that the investor, is taking on by giving them the exclusive option to buy the home.
Okay. I want to talk about having another buyer step in their place.
In the tenant buyer or an investor?
Yes.
Sorry,
if they can't accept their exercise their option, they need you mentioned having another tenant step into their place.
So in general, we would prefer someone not to step into their place, but if they truly wanted out of it, what we would suggest is to liquidate the asset, find a real estate agent and list it. And, you might pay the 6% or whatever the cost is. So I don't recommend buying a house and then selling it right away. Like in general, if anybody does that, you're going to lose money just with closing costs and agent fees. And so doing that, but we have had the potential of being like, okay, if you want out of this, if we find another tenant buyer, we might be willing to give you X amount of your option back, but really it's not designed for them to sublease it, even though we've had some individuals that have used our program to just actually buy investment properties, doing adult foster care or looking at short-term rentals, even though we're more designed for people that, I would say we're the highest cost option out there, but we just provide a lot of flexibility for someone that doesn't want to wait or wants to pick their home and kind of control the outcome of their kind of family financial situation.
What if it's a great house and this person, for whatever reason, maybe they want to move to a different state. Would you not then consider keeping the property and looking at your list of buyers if there was a buyer in the same city and say offer that property to them?
Yep, and we've done that, and we've offered it, put it on Facebook Marketplace, put it on Zillow, advertise it, and then we can say, hey, here's the new terms. It just gets a little bit tricky with the paperwork because when you do an option to buy, the option fee is non-refundable. Like
Right.
that's the risk that the tenant is almost like a down payment on a house.
Right.
Like you don't get that back, but if you were to liquidate or if you were to sell it, like that'd be one thing. But if someone came in and assumed your mortgage, like there's kind of a different play on how much they'd be paying that person for the right to live in that home. But if they went and found someone that just said, hey, I'll take over this home, and assuming that we screen them and go through the same process, I don't see any reason why us, or if we've assigned it to another investor, wouldn't want to continue to see that same cash flow.
It's been my experience with lease options that sometimes the people just don't care. You just kind of shake your head and go, okay, but it's like they almost distance themselves from the money they put down in the beginning. It's the strangest thing I've ever known.
And I would, I'll call it 4 years into this. And so we're relatively, I would say, new into the space. So I learned from like the Joe McCalls, the Wendy Pattons, and they would always find an off-market deal and then put a tenant buyer in there, which I always thought was a better way of doing it because then you're buying it right plus selling it right. I just didn't like the idea of finding motivated sellers when I had a list of a bunch of motivated buyers, and we can just still cash flow, maybe not quite as good numbers, per deal, but all we're doing is we've bought all 50 homes just one at a time. And it's just a bunch of, it's kind of boring, but it's just a single base hit, cash flow $300 or $400 every property for 50 properties. And, it kind of works. And now it's turned into a business that we can then do a couple different things. But that was one of my fears as well, as we created this whole podcast called Pre-Approved, and it's dedicated to tenant buyers. Like what to look out for. Don't sign a 1-year lease option or contract for deed that, you're just, yes, you're going to get financing because everyone thinks that they can in 1 year and then they don't. And what I really dislike is the landlords that'll take someone's 5 or 10 grand, keep it for a year, kick them out, and then just do it again. Because although it's financially lucrative to the landlord, that is not what we want. The homes that we're buying for people, we do not want the home back. This is their home. Like it's in our best interest and in theirs to actually exercise and buy the option, which is why I became a licensed mortgage loan originator, where it's like, okay, now that you're in your home, like you got 36 months, like great if you can do it in 5 months, but that's part of our program too, is like, okay, how do we get them to succeed? Because that's a win-win across the board. We don't want the property to fall in disrepair. We don't want them to walk away from their option. When they buy the home, this is how we get the 5-star reviews that people, give us. We got one refinancing here tomorrow on a $400,000 house in South Carolina. And it's like, okay, they're working with their loan officer and there's like, okay, we need to see this paperwork, and they're going to, buy it back at the traditional mortgage. And that's exactly how we want to see this go. So that, those 50 plus podcasts, plus our website, plus other content, it's like, just be really careful on what sort of contracts you get into. So we give away contracts. We've had an attorney talk about lease options on our podcast and like the do's and don'ts. But you're right. It is sometimes tough because some people just want the house and then life happens. And I don't want to control someone. Like, I feel like we're trying to empower them and give them an option. Like, you can get a mortgage, you can get a rental, or you can do a rent to own. Like, I'm just providing the option. You can tell me no, and we would take no offense. We just like to provide that option because I know that the last 12 people that we put in a home, no one else on planet Earth could have gotten them into that home than our company, because no one is uniquely just finding a person and be like, oh yeah, go home shop somewhere in, nowhere, Nebraska, and I'll just buy you that home, sell it to you on a lease with an option to buy. So that's what I really like about from a cash flow, but then how we're helping some people that might not have as many options.
That is definitely one way you're different. Are there other ways you're different from other companies?
I would, it's funny, we just did if there's any business owners on here, we're doing the Blue Ocean strategy canvas, where you, on the x-axis, it's like all the things that the customers care about. And it's location, it's home condition, it's monthly payment, it's down payment, it's certainty, it's, underwriting criteria. And so then we kind of did the matrix of like, oh, how are we different than a Home Partners of America or a Divvy Homes? And so for us, uniquely, I'll call it, we're the premium price. We're gonna require more down and more of a monthly payment premium than other rent to own companies. Like that's our, call it our bad or our red. The positive is any home, anywhere, no minimum credit score. Because all we're trying to do is, if someone came to me and they said, hey, like, I'm really in a bad spot, but I have X amount of money. To me, it's like a risk to reward. If someone's willing to put down 30% on a home, for me as the investor, like there's like, that's the biggest lever, is the loan to value or the price to value. Because in the event that they default, okay, now you have a home at, if it truly is, 70% on the value, it's almost like you're kind of buying it off market. And so although we still want to set them up for success, really, to me, and what I believe the investors care about is, okay, can they get some, rent insurance on it? And then how much skin in the game does a tenant buyer have for the risk to reward to be appropriate for that level of investment?
Okay. We talked a little bit about the MLS and about going over the asking price and the dangers of that. But the inventory now is so tight across the country. How is that affecting your business, and how are you dealing with that?
Sure. So I'll call it. I'll answer the question first, and then I'll have maybe like a 3-step process of maybe some different ideas that people can use. So number one, when the inventory is low, generally the competition, like for us, we're still seeing competition relatively high, getting multiple offers, doing various different things. And so for us, it's the contingency. But for us, it's like, oh, you know what we could do that's kind of cool? Close all cash and close fast. So if we're now an all cash 30-day close versus someone that's an FHA loan at a $300,000 house, we're an LLC, we got a pre-approval letter. Like, that's one way that we could get a little bit creative on how to attract, or maybe be a little bit more competitive. I maybe don't have the best answer to it, but for me, for real estate, it's, if you're trying to time the market, it's going to be tricky. And if you're playing the long-term game, of course, you subscribe to the Warren Buffett of, being greedy when people are fearful and fearful when people are greedy. And so like, I wouldn't recommend paying 10% or 20%, but like during COVID, I would happily pay 10% over asking if I got a 3% interest rate. Like it's almost like, so similarly, like if there's no inventory and if you really think like a housing bubble is going to happen, sure, wait, do that. But if you like have to move, one, like you're in it for the long haul. And if something does change, or, how to get creative on buying the home, but that would be my initial thought on the low inventory. And so then it's kind of came to a 3-step process, and it's tough because every spot's a little bit easier. But I always say, number one is if you can list your existing home for rent, that's one of the best ways to get into real estate. What we started doing, which was step 2, which is we would buy homes contingent upon a signed lease. In a seller's market, that contingency oftentimes is like hey, no, we won't do that deal. But that's a way that we found to get a home under contract, market it on Facebook Marketplace for the 45 days that we're under contract to close, and usually have just a normal tenant lined up prior to closing. And if we don't find a tenant, some people call it the weasel out clause, but like that's how if someone wanted to make an offer today on any property and I had a contingent upon a signed lease and the numbers worked for me, like why wouldn't I close on that home? And then, kind of step 3 is now we're finding, people first. So I already know that the lease is on there, but that's probably the number one thing that I hear is like, well, I can't find any homes, or they're going too quick, or I can't find anything that cash flows, and not, getting in the game, or not, increasing their portfolio, which may, hindsight will only tell, but may be a good strategy, may not. I'm all about the dollar cost averaging. I'm going to continue to buy, and we might buy high, we might buy low. And it's been kind of crazy what's happened ever since 2009, that it seems like no matter what you've done over the last 14 years, everything's just been good.
It all seemed to have worked out. For folks that weren't around weathering that 2008, 2009, that was an interesting time. the whole world was on sale. All the properties were on sale and no retail buyers could get a mortgage. So that was a weird time for sure, but it was a great time for investors. I mean, it was great for people that were, no matter whether you were buy and hold, or it was a little bit trickier if you were a rehabber, because you did not know how long you were going to have to hold that property. And that's what I found. That's when I became an accidental wholesaler. So, but we all learned a lot of lessons. Some of them were more painful than others during that period of time. I think you've done a great job, Adam, of telling people about your business model and how you help people that are, for whatever reason, can't get a traditional mortgage now, because there are a lot of people that have cash, but because of a divorce or some other financial misstep, they cannot get a traditional loan right now, or they don't want to wait even the 6 months or a year to get into that. So I think you provide a valuable service. So what final advice would you like people to know about this process and what you all do?
Sure. I think I'll do a couple stats and then maybe one summary. So we found out that there's 150,000 people searching rent-to-own homes into Google every single month. I had no idea it was that high. I had no idea that 11.1% of all mortgage applications get denied every year. Had no idea that there's 2 to 3 million people get denied a mortgage every year. So it's like knowing that there's this niche and how can you uniquely serve them? I'm always of the opinion, and the advice that I would get is you're probably sitting on some unique advantage in life. It might be the fact that you know an area better. It might be a fact that you know someone. It might be the fact that you're really good with numbers. It might be the fact that you're willing to take risk. It might be that you have capital. It might be that you have a lot of time. So I would, if you're just sitting in the car, if you're at the gym or doing whatever, you're like, there's probably one unique capability that I got an unfair advantage of, that if I pull on that lever, I can likely leverage it. Maybe you can get a bank loan. Maybe you have capital. Maybe you have friends that have capital. Maybe you have time. Maybe you know this area. Maybe you know a strategy, off market, seller finance, doing something. And as opposed to, and I would still get curious, and I've done a bunch of courses and coaches and listened to great podcasts like this. But if you really think about it, there's usually one thing they're like, oh, I'm really good at this. And my advice would be lean into that, because I can't tell you, and only you know that. And you'd be like, oh, this is a great strategy. And it's like the flavor of the month, right? Oh, there was short-term rentals. Now it's rent to own. Mm-hmm. Then it's the BRRRR strategy. And then it's something else. It's like any of those with consistency can work, but just think about who you're trying to help, what you're trying to do, figure out what that one unique lever is. And then I would say go in on that.
That's great advice. What's the best way for folks to get in touch with you, Adam?
If they want to learn about this process, they can go to homeequitypartner.com/investors. Otherwise, if you're just curious and connecting about what's going on, engineeringrei.com is where I have a little community where I have a passion for working dads that happen to have young kids, because it's sometimes easier to buy a house than get my toddler to put on his shoes.
Yeah, I know all about that one. I will put all the links below too. So all the different ways that you can connect with Adam. So thanks so much for coming on the show today, Adam. This has been, it's been a lot of fun.
Thank you for having me, Sharon.
And thanks to all the listeners who tune in every week. I would appreciate it if you would share this show and leave us a rating and a review over on iTunes, because it helps people find us. And I will see you same time, same place next week. Bye for now.